looks at your asset allocation as it stands. You can review this information, you're familiar with it. Page 4, I want to stop here for a moment. This is our capital market expectations for the next decade. And you'll see, going down the column across the various asset classes, what is a median out that we can expect to earn. One of the challenges facing trustees, institutional investors writ large, is the relatively muted nature of the expected returns. Right? So if you have a 7.55% target, it's tough to really get there at a median case across these various asset classes. And so that's one reason we think bringing to bear, what we'll talk about in a moment, being private credit and infrastructure could potentially help you in that direction. So what does this look like? Page 5. This is really the meat of the presentation today. And this is what you saw last week. There are a couple different scenarios for the investment committee to entertain in going down this road. The first is the easiest, right? Private equity had a target of 8% in your investment policy. It has persistently been overweight and closer to that 10% target. So we're not really moving any new assets into the asset class, but just recognizing the actual weight that it occupies within the fund. And so that would be an increase from 8 to 10, where it stands today, really just a recognition of this asset value. What is new, however, are these asset classes kind of highlighted in the middle of the page: private credit and private infrastructure. There are two alternatives, the first being entertaining a 1% allocation to each of these new asset classes, and then alternatives 2 and 3 would be a 2% allocation to each of those asset classes, a 4% total. Based on feedback from the last meeting and discussions with staff, Cal is supportive of alternatives 2 and 3. So 2% allocation to each of these asset classes for a number of reasons. One being that these are going to take quite some time to fund up, potentially years. And so you want to have enough room there to really build out this asset class and not have to come back and make changes in the near term. Additionally, a 1% weight doesn't really move the needle in terms of total return in the field. So that slightly higher weight will have a slightly more meaningful impact. So how would we go about funding these? If you were to look at, say, alternative 2, which I'll just cut to the chase, is the preferred alternative supported by staff and talent. You need to come up with 4%, and so that would be a 2% reduction in domestic equity as it stands today, from 27 down to 25%. And similarly, a 2% reduction in international equity from 22% down to 20%. So that 4% allocation that you've created room for now will be split, and half going to private credit, half going to private infrastructure. The last bit of this whole moving pieces is why would you fund it this way? And sorry, actually, hold on, I need to back up. There's also a reduction in total fixed income from 20% down to 18%. So we view funding private credit from your existing fixed income managers makes sense. Private credit is fixed income oriented. We do expect a bit of a return premium from this asset class due to its illiquidity. So that's kind of a like-for-like transition in some respects. Moving equity into private infrastructure similarly makes sense in terms of return risk characteristics. So alternative 3, the only difference would be you would fund both of these new asset classes solely from your public equities, and you would leave fixed income untouched. We think that the risk-return trade trade-off from reducing both equity and fixed income makes a little bit more sense. And we can see that kind of towards the bottom of the table where we look at the 10-year return and risk. So what would these moves do? Now, don't look at the actual numbers. This is carried out to 2 decimal places, really implies a level of precision that is not what we're going for. It's more directionally what is happening. So you're taking on a bit more risk. So your risk is going up slightly, but your return is also going up in a commensurate amount. And I think that that's a very good trade-off for you. When you also consider that these will be diversifying asset classes, not only due to their private market nature, but also they just have different return drivers than your equities and bonds. So let me stop there. And are there any questions so far about any of this information or the potential movements in assets?
Talk to me a little bit about the bottom of that chart, where the illiquid assets would go from 18 to 24% on their alternate two. That's a 6% increase. Is that what I'm saying?
Yes, that's correct. So what that reflects is the 2% to private equity from 8 to 10. But it's already at or above 10, so there's no real actual changes there. So that's 2 of the 6. And then you've got 2% to the new private credit strategies and 2% to the new private infrastructure strategies potentially. So that's where that 6 comes from.
So currently, if you look at our current asset allocation, we're currently at about 20% illiquid now because of where we're actually allocated. The target is lower than what we're actually allocated. So that 2% is already in the portfolio as we're currently allocated. So
That's right. And then the last piece is, that 24%, how does that jive with the basket clause? 20%, well, that excludes private real estate, the basket clause does. So that, because the private real estate is fairly illiquid, is part of that 24%.
Does illiquid mean in financial terms what it means to me in my common sense terms? It means once we get invested in there, it's hard to get it out. We can't, I mean,
That's correct.
It's stuck there, so we're putting money 6% more in there that we can't get to if we need cash. It would have to come out of the other areas. Is that what that means? Is there a downside? What is the downside to us making more of our assets illiquid?
Yeah, and that, you hit the nail on the head. One downside is that you don't have ready access to that capital. So private credit, private infrastructure potentially could be like core real estate where you do have, quarterly liquidity. You're not locking this money up for a decade. But still, it's much harder to get at than the public market investments.
Okay, so Charles, with the cash that we need every year to pay our cost of living, especially the big number that comes at the end of the year, how is that going to impact you and your staff now to try to get to that money if we have 6% more in the illiquid sort of things there?
Well, okay. First of all, private credit it's a fixed income product, so it does produce an income flow that can be used, to pay. And then we also spend a good bit of time with Callan, making sure that we're timing the flows into these asset classes at a rate that's not going to put us at a disadvantage liquidity-wise. So there is illiquidity in these asset classes, but the benefit side of the diversification and muting volatility that we're receiving from the public assets way outweighs, that, a little bit less liquidity.
So, Ray, will this on our funding policy have any impact on our cash flow that we looked at? Will that calculation be impacted by the changing of our asset mix here? I mean, in the way that would be calculated by our actuaries?
I don't think so. Great question all the way around, a good discussion. In the funding policy, I recall that basically being the benefits going out and the contributions coming in, not so much the reflection of the investment income. So I think probably there shouldn't have an impact there.
Well, that's the reason I'm asking the question, because I get them confused, and I just want to make sure that linking more of our assets, illiquid, is not going to have an impact, a detrimental impact, on when we need the large sums of cash.
Yeah, it shouldn't in respect to the funding policy. To piggyback a little bit on what Charles said, great question, and no doubt that these are more illiquid assets. But I guess it would also be true to say, I already touched on private credit with its fixed income attributes, if you will. Would it also be true to say that since we've been in some of these other investments in private equity and real estate for years now, the older ones, from time to time, we have the ability to redeem that money, or they're basically throwing off funds? Speak to that a little bit.
Jason, do me a favor, tell me exactly how much real estate and private equity is thrown off.
John, I think you had your hand up. Do you want to comment further on that?
Yeah, so the benefit policy would be unchanged, right? The amount of cash that your distribution to participants, that is not going to change from the prior actuarial studies that you've done, right? The impact that it has is like tapping in to pull cash out of your investments to pay for those benefits. And when we did the asset liability study, we look at what is the overall liquidity. Are your distributions as a percentage of the total fund such that we need to be mindful of increasing any degree of liquidity? And yours was certainly not at that level. So that, when we go through and make a determination of to include an illiquid asset class, that's one of the considerations. We have some clients that their percentage of distributions as a percentage of total fund is such that we back off any new illiquid investments. That's not the case in Mississippi PERS. So when we did the study, that's something that we looked at.
And in reality, of course, we're speaking on this sheet to target allocation, but in reality, with the capital appreciation on the private equity side, I guess to a lesser extent real estate, we're really a whole lot more illiquid in reality than what we're saying now, right?
Yeah, because when I look at, the target, right now the target for private equity is 8%. You've got about 12% of your total fund in there right now. Illiquid, so we can't redeem. But the one thing that, to Ray's point about an insure program, both on the real estate side and the private equity side, is that it's at a level that it's throwing off cash, that you can use that cash to, you may recall when we talked about private equity, we talked about the J curve, right? That investment period that's down here where you don't have any liquidity coming back. But once you get to a certain point, your investments are maturing, you're putting more money back in, but they're also sending money back. So that's kind of where we're at this point.
And it's not as liquid as equity, but it's sending money back.
It's sending money back, yes.
It'll be more illiquid at the beginning than it will be as these continue on throughout the years. Because there'll be these times where there's payments back or recoupment of those funds.
Yeah.
They may be reinvested or may be used depending on what the strategy is and what the cash needs are.
Yeah, and so, we annually we produce what we call a casing study because, the liquidity of that private equity component year to year, depending on what happens in the underlying holdings, if they go public and they cash in, that cash gets spent. And it's not always just a straight line, right? So we go through a pacing study and say, okay, how much cash is coming in? Long-term target is still 8%, We're at 12 now, which means that there's gonna be a period where you're gonna be throwing out more cash than is going back into investments to get you down to that 8%. But if we increase it to 12%, all we're doing is saying, we're here right now, and instead of coming down here to 8%, we're gonna be a little more gradual at 10%. I mean, it's a great question and a critically important one.
Other questions?
There's no other questions. I'm asking for you to accept alternative number 2, increasing private equity to 10% and giving us the ability to move 2% of the portfolio to private credit and 2% of the portfolio to private infrastructure. Funding coming from both fixed income and public equity.
All right, so everyone's clear, alternate 2 is the recommendation of staff and Callan. Domestic equity going down 2%. International equity going down 2%. Total fixed income going down 2%. And then with offsetting private equity up 2% from 8 to 10, and then private credit up from 0 to 2%, and private infrastructure from 0 to 2%. Any questions?
Yeah, tell me one more time how that ties into the basket clause now. Those 2 in the private credit and private infrastructure are specifically those that are in that basket clause area.
And so is private equity.
Okay.
Yeah,
But real estate is not?
correct.
Okay.
Yeah, the way the statute reads is that if you want to make a prudent investment that's not part of the enumerated asset classes, then you can do that up to 10%, and then effective July, it goes from 10 to 20%. And why is that important? Is because the private equity is not one of the enumerated asset classes, but real estate is. So real estate has its own category, so that's fine, we take that out. Private equity does not, so that falls into the basket clause. Private infrastructure and private credit also fall within the basket clause. So that's how you get to that basket clause exposure.
So we're at 14% with this at some point, if it reaches that amount. And then that's to give a little headroom for increases, just like private equity has done, any increase in the value of that. So that if that appreciates, if you will, we go up to 16, 18% before it would be called, or there would be payouts from it, that we wouldn't get ourselves into too much trouble with the 20% as of July 1st, right?
Basically, the statute speaks of book value, but you're right, it's 14% of the new 20% cap as well.
Okay.
But Dr. McCoy, I represent the retirees. Do you anticipate this being any change in pocket money that goes to the folk we represent?
No.
Good.
Benefit change or anything here.
Good.
One thing we didn't talk too much about, Alex, I think mentioned it in the terms of year, maybe speak a little bit, just broadly on the implementation timeline. I know it'll take a while anyway, but particularly in this economic environment and the market status right now, that may be something we don't want to do next week.
Absolutely, we want to be thoughtful about the timing of any sales of the existing asset class and work with staff on that. But more importantly, implementation in these private asset classes is arguably more important and more challenging than it is on the public side. And it takes quite a bit of time to source these deals. And so we're looking at conceivably a period of years to get this money allocated. We'll be thoughtful and prudent about the process, not rushing it. This is for the long term. But it's kind of like starting a private equity program from scratch. You have this target and you don't fill it on day one, you kind of build it. So it's going to be a much longer time frame.
When we started our private equity program, it took us years to get to where we're at today.
same thing in real estate, in terms of implementation of that, getting the core established, and then adding the supplementary strategies to that, right? So again, the idea is that unlike public equities, where you would say they're daily traded, right? Where you would do a search, 6 to 8 weeks later, you've got a manager, and you say, okay, we're gonna move the cash to fund this manager, 10, 12 weeks out. This is a little more complex in terms of identifying the core, identifying the complements to that. So more akin to a private equity or a real estate program than a public equity.
All right, and do we have you've heard staff recommendation, to go with alternate 2 under the proposal they've submitted? Do we have a motion to approve that?
So moved.
I second.
We have a motion and a second. Any further discussion?
The only discussion is the one sentence that I remember when we were discussing the basket clause. It would be, more return, less risk. That's all that I remember.
More return, less risk,
Yeah, that,
which is always what we're shooting.
way back when. All right.
All right. We have a motion and a second. All those in favor say aye.
Aye.
Any opposed? All right, motion carries. A lot of work. Thank y'all very much. A lot of work for y'all.
That was a lot of work getting to this place. From a lot of people, so thank you. Mr. Chairman, up next, we have manager presentations. We have four real estate managers and a timber manager coming today. The first 2 up are JP Morgan principal, and we'll hear them. This is kind of different than what we normally do, because we had to kind of move the schedule around because of scheduling conflicts with manager search presentation. So we'll have 2 managers come in before lunch, and we'll hear from 2 with 2 different portfolios after lunch. So the first one coming in is JP Morgan, it'll be Kim Adams and Jeff Boggs. And in the packet, there was a manager preview that Jason put together, just to kind of give you a overview of who these folks are, what they do, and how they do it.
These are 15 to 20-minute presentations.
15-minute presentation, 5 minutes for discussion.
Please proceed with the presentation.
Perfect. So let me just kick it off. My name is Jeff Fox, client advisor with JP Morgan, 22 years with the firm. I'm on the Southeast team and covering PERS for since 2006. So we appreciate the business and support and the relationship. Kim Adams is with me today, lead portfolio manager on the Strategic Property Fund. 20-minute discussion today about real estate. Obviously, it's been a tough year. We're one of the bright spots in asset allocation. So Kim will spend a few minutes talking about the portfolio, but the majority of the time we'll spend focused on outlook going forward, seeing as a lot of macro news around interest rates, inflation. So Kim, I'll turn it over to you.
Thanks. Thanks for having me today. I'm going to speak for 3 minutes on what drove the extraordinary returns over the last few years in core, then talk about what's different today, and then give you a sense for the portfolio positioning and outlook with no more than 15 minutes of commentary, and feel free to stop me as we go along. So when you look at the core returns, whether it's Strategic Property Fund or any of your core managers, you'll see that we've returned over 26% in the last year. That is really as a result of 3 things. First, the fundamentals broadly in real estate have seen explosive growth. We have had inflation that has been captured in growing rents. We have a very strong consumer that's been supported by the government and all the money that we've pumped through the system. We've had extremely profitable companies, including tech, which has seen historic highs in terms of stock prices, hiring, expansion, etc. And we've seen a housing shortage in this country, which is driving demand both for homes as well as apartments. Secondly, historically low borrowing rates. Over the last couple of years, we have seen debt for high-quality assets in the low 2% range, which has put pressure on cap rates coming lower, which is making values move higher. So the capital flowing into real estate as a result of the opportunity to buy with extremely accretive debt has also helped to move values to help generate that 28% return that you've experienced over the last year. And then the third thing I'll say is that over the last couple of years, what's been eminent and prevalent is that we have seen performance dispersion like we've never seen before in real estate. You know, typically real estate, by sector, by geography, or by type of asset, tends to revert to a mean. That has not been the case in the last 5 years. We've seen industrial with 50% plus returns. We've seen retail with 4 or 5% plus returns. We've seen California and the South experience growth and consistent rent increases. We've seen markets like New York and DC lag. And then in every sector, we've experienced a flight to quality such that the strongest assets in a particular sector can significantly outperform the weakest. You know, think about malls as a great example of that. There are, 200 malls in this country that are attracting all of the shoppers and all of the retailers today, and they're driving strong growth. And then you can drive by 500 malls in this country that are literally going to be bulldozed for a different use. So this notion of dispersion is one that's really important going forward. Because if you look at the 3 things that drove returns over the last 5 years, the explosive growth in the fundamentals, the low borrowing costs, and then this notion of dispersion, you fast forward to today. So fundamentals are still very strong. We are seeing strong rent growth in apartments. We are seeing strong rent growth in industrial. We are seeing absorption in office, and we are still seeing a strong consumer, particularly for experiences, restaurants, movie theaters, etc., driving growth in the best centers. That growth feels compromised today. We don't know where it's going to end up, but certainly with gas prices, the world getting more expensive, there's no question that that growth is going to slow. So it has not yet been realized in real estate. However, the demand or the fundamentals feels more challenged today in terms of continuing to grow at the same pace. The second point point I made was that much of real estate's been fueled by low borrowing costs. Well, 2.5% debt 9 months ago is now 4.5% debt. And we're in a situation in real estate where we're negatively levered, which means today pricing for an industrial asset or a multifamily asset, as an example, could still be at a 3.5 cap rate. Debt costs 4.5, and the reason somebody would pay a 3.5 and borrow non-accretively is because they see the growth trajectory of rents that is going to enable them to get out of that negatively levered scenario, which obviously, as the demand piece of the equation becomes more compromised, becomes riskier. So we have more risk to growth, we have higher borrowing rates, and the power of this performance dispersion is still extremely prevalent. And that is all about what sectors you own, and more importantly than ever today, what you own within those sectors. Flight to quality is something we see in every slowdown, whether it's a slowdown or a recession. And I expect that we'll see that again over the next several years as the market moderates overall. So that's at a very high level how we see the world today. It certainly feels that a slowdown is more probable than it was 6 months ago. And I think it's really going to come down to how the markets ultimately react, how the consumer starts to react, and more broadly, where the demand will slow in the markets. So I'm going to turn you to page 25. You don't necessarily need to look at the slide. I'm going to use it as a resting place here. And talk to you a little bit about, given what drove returns, where we're headed in terms of forecast and outlook, what are the key themes for Strategic Property Fund that will enable it to outperform going forward. This fund has always been positioned for resilience and for growth, and we are at a point in time where that is no different. First and foremost, Strategic Property Fund is highly focused on asset selection. In every sector, what we own significantly outperforms the peer set because we own higher on the quality stack. We have been very selective geographically about where we own in growth markets. And as we see the market and this flight to quality coming together, we believe that asset or stock selection is an important driver of return for Strategic and a more important driver in the markets more broadly. A generic allocation over the last 5 years was the ticket to outperforming. If you owned a lot of industrial, you outperformed. We're going to look at Strategic's performance in a minute, and you'll notice that we underperformed in the 3 and the 5 year. That is solely due to an underallocation to a high-performing sector. That is behind us today. Our allocation today is at par with our competitors, slightly over in terms of industrial, and what we own is significantly outperforming. So we have strong stock selection or asset selection. We've transformed our allocation such that we're tilted toward those higher growth sectors like industrial and multifamily. We have sold down office and retail even through the pandemic, and you'll see the allocations in a minute. And we have an accretive debt construct. So we did access the unsecured debt market relatively significantly over the course of 2021 and borrowed in the mid 2% range, which means the overall cost of debt for the fund is close to 3% against a market debt rate today in somewhere in the 4.5. So you'll feel the tailwind of your debt being marked appropriately, or said another way, you'll get credit for the accretive debt construct of the fund in your valuations going forward. So if you look on page 25, this was at the beginning of the year what we expected to happen in terms of overall performance based on what I just mentioned. We expected income to be 3.5% to 4%. I still expect that to be true. We expect stabilized depreciation to be between 500 and 700 basis points. And then we expect the development portfolio within Strategic to deliver somewhere between 150 and 200 basis points. Bottom left gives you a sense for where those returns are coming from by sector. Industrial and residential continuing to lead the pack. It's all about that strong rent growth that we've been seeing in those sectors. And office and retail, I underwrote to expect an income return plus some moderate appreciation. In office, we're seeing negative news in the East Coast being balanced with positive leasing activity in the West Coast, as an example. So I expected that to neutralize itself over the course of the year. 92% of the portfolio is stabilized today, meaning these are well-leased assets in the 90% leased range that are paying cash flow. 8% of the fund sits in development today. That's on the bottom right. That 8% is critical in terms of performance because it only represents 8% of the fund, but it is going to deliver 25% of the total appreciation for the next 18 months. That's 19 million square feet of industrial under development around the country, and apartments, roughly 4,000 apartment units and 1,500 single-family homes for rent. So this is what I expected at the beginning of the year. The next page shows you what happened in the first quarter. Oh, maybe not. Nope, it shows you, yes it does. Page 26. All of what we expected directionally was correct. Industrial and multifamily delivered the greatest portion of appreciation. The magnitude of the appreciation was higher than we expected in the first quarter. So 6.5% in the first quarter. I think this quarter we're going to be in the 3.5 to 375 range, which means you've already received roughly 9% of your 12% total return in the first half of the year. I do expect returns to slow, so I'm still comfortable with that 12% range if you add in the income, but I think that that 14% will be more difficult to achieve as we see the pressures of higher interest rates, as we talked about at the beginning, as well as potentially some slowing in overall rents. So I will make 3 comments about each sector briefly, and then I'll open it up to questions. I think first of all on page 27, what's important here are the allocations of Strategic Property Fund, which look very different than they did 5 years ago, and importantly are going to continue to drive return, particularly now that the asset selection is more important and the fund is now tilted toward those higher growth strategies. We are over allocated to industrial. Our office portfolio has come down significantly. That was at roughly 40% 5 years ago. Now it's more in line with Odyssey. And our retail portfolio, which is still over the benchmark, has come in dramatically and is roughly 400 to 500 basis points over today. Our geographic exposures are really focused on the West and the South, with an underweight to the Midwest and to the East, where we see markets have struggled through COVID, more so, and these have been very accretive underweights for Strategic Property Fund. So let me just give you 3 bullet points for each sector, and feel free to stop me as I go, but I'm going to turn you to page 30. This is the office portfolio. What's important in office is what you own and where you own. When I say what you own, it is commodity office is no longer attractive to the tenants. They want vibrant nodes, they want light and air, they want big open floor plans, and they want somewhere where they can walk to their apartment, walk to lunch, and really feel a neighborhood or a community. And interestingly, I'll use sort of an example that we're seeing in London. There's no question that demand for office is shrinking. Work from home is going to have a contractual pressure on office demand over the next decade. So we've seen vacancy rates, as an example, go up in London, but we've also seen rates for Class A buildings go up. So what that tells you is while demand is shrinking, the demand is being concentrated in the strongest assets in these key markets. So What you own is very important. The bottom left of this chart gives you a sense for the type of office that Strategic Property owns. That blue is the type of office that's, quote, winning. And that gray is the office that I would rather not own today. And that's more of a commodity, mid-rise, midtown New York asset that I expect will have leasing challenges going forward, and so we've marked it appropriately in terms of our valuation. So what you own is expensive, is critical in office. Where you own is also important. If you look on the right, you'll see where our major city exposures are. We're exposed in these West Coast markets where we're continuing to see, even despite what's happened in the equities market, we continue to see tech companies sign leases, commit to long-term space. It is where the pie is expanding, and it's where we're seeing momentum. And then you'll see that we've got a lesser allocation to markets like Chicago, Dallas, and DC, where we don't see as active of a leasing market. So what you own and where you own is important, and then on the next page, importantly, it's where you've marked your properties. Over the course of the downturn, we took our commodity assets and we took our weakest markets and we took markdowns somewhere between the 10 to 30% range based on the type of building. So do I think office will be challenged in the next couple of years? Yes, I do, in certain geographies and certain types. And I feel Strategic's portfolio is well positioned, not only because of what we own and where we own, but also in our challenged assets, we've already absorbed that negative news in the values. So that's the highlights for office. I'm going to turn you to industrial, page 34. Strategic owns the premier industrial portfolio in Odyssey today. We are well diversified in terms of infill property, truck terminals, and outdoor storage, which is sort of an emerging sector that's basically parking lots for trucks. We have always had a mindset to be close to the rooftops, close to dense populations. That means infill Dallas, and importantly, it means LA ports near the populations in California. We have, on the bottom right, you can see what we own from a stabilized perspective are the purple dots, and where we're building, which has been a really, really critical method of Strategic garnering strong returns in industrial overall. When you are developing, you have the benefit of a return on cost and that profit margin to what that asset is valued at once it's stabilized. You can see the extraordinary returns that Strategic is delivering in terms of its industrial portfolio, 62% in the 1 year against a peer set of closer to 51%. I will also say that I mentioned at the beginning of my comments that asset selection matters more. And you can see that in the returns as time has gone on. So if you look at that 5-year number, look how close Strategic's return is to the peer set. It's basically saying that it doesn't really matter if you own in great markets, you own great buildings or not. Pretty much everything in industrial was being valued the same way because the rents were being viewed the same way. Over time, you can see how those returns start to differentiate. And you look at that 1 year number, and that should give you the confidence to know that going forward, what you own is becoming increasingly important, and what Strategic owns, particularly industrial, has the ability to outperform. Much of that has to do with our Southern California exposure. That's on page 35. You can see sort of the magnitude of the returns in Southern California, and then you look at Strategic Property Fund's share of industrial portfolio located in Southern California versus the peer set. So I think this is going to be a continued source of outperformance. Even if the market slows, this market will, on a relative basis, continue to generate significant outperformance. So you can expect industrial to continue to clip along, and you can expect in particular the development pipeline that you own to generate strong returns. I'm going to turn you to page 40. This is SPF's retail portfolio. It consists of 7 high-performing, high-quality regional malls. and then a portfolio of neighborhood and grocery anchored centers. First and foremost, I talked about what you own matters. You can see Strategic's retail performance at 11% in the 1 year against the peer set. On average today, our mall sales are 11% above sales from 2019. We've signed a significant number of leases as retailers look around the country and they decide where they want their stores concentrated. So they're opening less, but where they are opening, they are willing to pay more for that presence. They are following the consumer. They are studying the traffic. And they are in these major centers across the U.S. with a 10% net operating income growth trajectory for Strategic's retail portfolio in 2022. I also want to mention that with an eye toward what we think will outperform longer term, we sold roughly $2 billion of commodity neighborhood centers out of the portfolio in the first quarter of 2022. It was an important sale for us. We really got in right in that window where borrowing rates were still low and appetite for retail was still relatively strong. That was a profitable sale for us. It generated positive appreciation to you as an investor and was an important milestone for us in reducing the generic allocation, but more importantly, reducing the weakest assets out of the portfolio. And it's sort of described on page 41. I'll end with residential, which is also going to be an important component of Strategic's go-forward performance. You'll see that we're underperforming a little bit in the 1 year number by roughly 50 basis points. And I'll address that simply by saying we own more major city apartment buildings than the peer set. So our urban portfolio is a greater share of the overall portfolio, and the urban apartments took longer to recover. So if you move the clock back 3 quarters ago, we were still seeing a recovery of San Francisco, New York, Chicago, Dallas, DC, whereas suburban had already roared back as people left these major cities and moved to the south in markets like Florida, North Carolina, et cetera. So I believe that that number is going to even out over time. So suburban rent growth really did not slow at all through COVID, and it still has not slowed even in sort of the face of some of the headwinds that we talk about in the broader market. We've seen 15% year-over-year rent growth in the portfolio. Occupancies are at a historic high. Renewal rates are at a historic high, and we're just underhoused in this country in general. Mortgage rates are going up. It's getting harder for people to buy a home, which is continuing to fuel that multifamily rent growth. You know, one thing we talk a lot about internally is at what point is there just an affordability ceiling where these consumers say we just can't pay $4,000 a month for an apartment in Florida when our wages aren't growing in the same way that rents are growing. I do see that as a risk. So we're trying to calibrate the portfolio in 2 ways. First, we own very little in the top quartile of the most expensive apartments anywhere. We're trying to play in the space where we're in the sort of mid-quartile or second quartile in terms of expense, because that will help mitigate some of that affordability issue. The second is that we don't really have a monolithic view on we're just going to only own this type of residential. We own through the entire life cycle. We own the urban footprint for the young people that are just out of school that want to be in the city. Then we own in the suburbs where there are more 2-bedrooms as people start household forming and have a first child. Then we own in the single-family rental space where we've built single-family homes where people want more space and good schools. And then we own in the age-restricted. So the portfolio is very well laid out to calibrate across the demand over the life cycle of a renter. It is in that middle tier in terms of affordability across everything that we own. And it is diversified between Sunbelt markets, some in the West, some in urban. So you're going to continue to see strong growth from that portfolio on a relative basis, with the footnote or the caveat that if we move into, you know, a slower economy, which feels more likely today, those rents will slow. So those were my planned remarks. I would say, you know, really what I'm focused on for the remainder of the year is to continue to deliver on that development pipeline, both in industrial and multifamily. I'd like to sell a few more office assets before the end of the year. The market is very choppy right now, so I will likely wait until the third quarter to effectuate some of those sales. We continue to invest in the extended sectors with roughly 8% of what we own in these niche categories like truck terminals, single-family rental, outdoor storage, self-storage, life sciences. And that's it. What can I insert?
Questions from the committee? Consultants, staff?
So, I did have a question. So Kim, as we look at the sector by sector breakdown, looks like your selection is outperforming that of the Odyssey, but overall over the last year trail. And what do you attribute that to?
Our allocations were offsides because our industrial allocation was below Odyssey and it was the best performing sector.
Okay, so now you're closer to or a modest overweight to industrial, whereas over the last year you were underweight.
That's right. Over the last 5 years, we were underweight. And over the last year, we were still underweight, attributing to that negative performance. So now that the allocations are more in line with where we'd like them to be and more in line with Odyssey, you should expect that that asset selection should come to the surface in an even more vibrant way because the allocations are more right-sized.
Thank you.
And over the last 5 years, even if you owned the very best within the sectors, if you didn't own enough, the generic allocation would overwhelm the returns.
Any other questions? All right, thank you.
Thank you, appreciate your time.
Appreciate it.
Don't trust the portfolio management.
Good morning, how are you this morning? Good to see you all this morning.
Mr. Chairman, we have principal here to discuss their portfolio with us, Bill Grayson and Darren Slice.
Yeah, good afternoon, everyone. Great to be back. I think it's 3 years since the last time we came in and presented the U.S. property account. Quick introduction for the two of us. I'm Bill Grayson, principal's office in St. Louis. 22 years with the firm. With me today is Darren Kleiss, co-portfolio manager for the U.S. property account. 28 years with the firm, lives and works at our headquarters in Des Moines, Iowa. I think it's appropriate for us to start out by acknowledging and congratulating those Ole Miss fans for the big win yesterday. It was an amazing run. And again, since we haven't been here in 3 years, I will go back a year and also include Mississippi State, or last year's victory. I think it's again remarkable that back-to-back in 1 year for the same state is something to be proud of. So that's all good news. We do appreciate you having us in. We are more than happy to come in and present after really coming off our best run of performance ever in the 40-year history of the U.S. property account. We had our best quarter ever in the fourth quarter of last year. We had our best calendar year in 2021. We're coming off the best one-year return at the end of the quarter. Probably the best 3, 5, and 10 annualized returns we've ever had after the first quarter of this year. So again, it's a lot of fun to come in and get good news, because there hasn't been a lot of that lately, I hear, from the equity markets. But one of the main reasons you invest in private real estate in the first place is to lower the volatility of the total portfolio. So far, 2022 has been the perfect storm of returns to kind of verify that reason for having that lower volatility, to reinforce that reason. You know the numbers. S&P's down negative 19%, NASDAQ's negative 27%. Worst bond market ever, the first quarter, negative 10%. The U.S. property account year to date is up 10%, and over a 1 year period, we're up 30%. So probably the biggest dispersion we'll ever see between private markets and public markets. And again, the reason you're in private markets in the first place. So happy to be part of that for the portfolio. Moving forward, though, in a rising rate environment, in an environment where we had no love at all from the central banks anywhere in the world, how you execute on your strategy and how you position the portfolio matters a whole lot more. So that's what we're going to cover in the next 15 minutes. And again, we appreciate the time to be here. I will cover a couple of comments on pages 5 and 7 of the book. If you want to join me there on page 5. Just a little history of your investment in the U.S. property account. You've been an investor now for 19 years. Started with $100 million way back in 2003. Added $425 million at various times, and variously well-timed, I should say, over that time period. We have returned to you $250 million at various times, but yet you still have over $1 billion invested in our fund. That's almost $800 million in added value during the time you invested in the U.S. property. So, core real estate has been very good to PERS Mississippi. One comment I do want to make on page 7 of the book about the portfolio management team. John Berg is at the top of the page. You've seen him most of the time of these board meetings over the last 19 years. John, longtime portfolio manager for the fund, took a role as head of private equity portfolio management at Principal several years ago, 3 or 4 years ago, which really began a transition at that point to full-time day-to-day responsibility to Darren Kleiss and Negan Phillips. That was formally kind of that period finished early this year. So now co-PM day-to-day responsibility is Darren and Negan. Very happy to have that. John's still in the investment committee, still has an oversight role for the fund, so he hasn't gone anywhere. And we still are left with we think, a portfolio team that is at the longest tenure of the core fund world in the industry. So, and we've added to it over that time period. So, great team moving forward, great strategy moving forward. I'll stop now with any questions. Darren?
Thanks, Bill. Take a look at page 8 in the materials. Kind of gives you a high-level snapshot of how the fund looks today. The fund's just over $13 billion in assets, about 150 properties, and a couple key indicators that we pay a lot of attention to on there. One is our leverage ratio, and the other is our 1-year net absorption. Portfolio occupancy of 95%, and that 1-year net absorption is simply a measure of how many square feet are leased in the portfolio today that were not leased a year ago. And so the past 5 years, we've averaged about 1.1 million square feet of new net absorption of tenants moving into the portfolio. It gets harder to generate those kind of numbers when the portfolio is 95%, but a good key indicator that we've focused a lot on that kind of translates into income growth and returns, which we'll talk about in a few minutes. Contribution Q balance at the end of the first quarter was $206 million. Currently, as we sit today, it's about $530 million of new investment looking to come into the fund. That capital will probably be called in the third quarter, available to fund